Hello, my name is James Gedge, Realtor, and today I have the awesome opportunity to be with Dean Duncan, CPA tax professional. Today we are continuing our series on downsizing your home. Today we are going to be talking about what do taxes look like as I'm downsizing, and then the many other aspects in that area. But before we get into it, Dean, will you introduce yourself?
I'm Dean Duncan. I've been a CPA for about 40 years. My company is Premier CPAs Inc. here in Salt Lake City. And I mostly work with small businesses and individuals as far as taking care of their tax filing requirements, as well as advising on business aspects and taxes related to that.
Excellent.
Okay.
Well, let's get into downsizing. What is downsizing? Well, in this conversation, downsizing your home, it applies when you probably raised your family in your home, kids are gone, you're now an empty nester. Well, I have that yard that I hate mowing, too much square footage, I never go in the basement anymore, it's just full of boxes that I never use, or once a year, Merry Christmas, and that's it. But maybe your life has changed the direction and your priorities are different and you no longer need all that space, and so you're looking to downsize your home. So Dean, what do taxes look like when you're selling your home and moving to a new home?
There are some things to be aware of. First of all, I'd like to kind of cover an old tax law that I hear from clients or passed down from their parents or whatever. Maybe they aren't old enough to remember the old tax law before 1997. The previous tax law was you had to buy a more expensive home, buy up, in order to avoid paying tax on those gains until you were age 55, and then there was an allowance at that age or after that you could sell your home and exclude up to $125,000 of gain on your home.
In 1997, that was different than today.
That's right. Here we are, 2024. And the only reason I bring that up, not to confuse anybody, but I still hear that from some clients, and so I end up saying, well, you know, that's an old tax law. You don't have to worry about reinvesting the proceeds from the home sale into a more expensive home to avoid tax. So set that aside. That's the old tax law from pre-1997.
2024.
The new tax law. You can sell your primary residence. You don't have to be age 55 or older, which was the old tax law. You can be as young as you might be at the time, as long as you've lived in the home as your primary residence 2 out of the previous 5 years, owned and lived in your home. So that's the key. If you're in the home, you've lived in it with your family, you can be young, you don't have to be over that age 55, so that's kind of nice. 2 out of the previous 5 years, so 2 years at least out of the 5 years before you sell the home. It's your primary residence. You can exclude, for single taxpayers and head of household, it's $250,000 of gain on your primary residence. If you're married filing joint, it's $500,000, up to that much of gain that you could exclude. If the gain is more than that, you still get the $500,000 or $250,000, but you pay tax, capital gains tax on the part that would be more than that.
Primary residence only.
Correct.
I have a secondary home in St. George.
Whatever home is established as your primary residence, and what establishes that is several things. Where you vote, where you go to church, where you get your mail, where you spend the most time. Some people might be spending 6 months in either place, and so it might be, kind of a toss-up. But if you're getting your mail and voting and go to church and your kids go to school in a particular one of the 2 places, that would establish that as your primary residence. And you can manipulate that. If you see a sale coming up, you might say, we're going to sell the St. George home, let's make that our primary residence. So you change where you vote, change all these things that might tip it that direction if your time spent is about 50-50.
Do that for 2 years.
If you see it coming up and know that you're going to maybe sell that, make it 2 years and then sell that home. And Meanwhile, you still have your Salt Lake home, or vice versa, whatever the case may be, and that can then become your primary residence. This exclusion can be taken every 2 years, or no closer than 2 years apart. So if you've sold one home and taken advantage of that exclusion, and then it's 2 years later plus, you could do it again.
Basically, because it takes another 2 years to reestablish that as your primary.
Correct. I have a client, when this law first took place, he was a builder actually, and I said, hey, you should take advantage of this law. He was a young guy, young family. They lived in a home, had a gain that, because he built it, there was a gain already. He sold it. He now lives in a very nice home after about 5 moves since 1997, and hasn't paid any tax on the gain.
That is brilliant.
It's fantastic, but not everybody builds their own house or wants to move every 2 years. I'm aware of that law, and my wife and I decided we don't want to move, even though we could take advantage of that exclusion. We like our neighborhood, we like where we're at. Yeah. So even though it would be to our advantage to do that same thing, we choose to stay where we're at for now. As far as the 2-year period, the IRS is very specific about that being at least 2 years to the day, that it's your primary residence for that to qualify for the exclusion.
From date of purchase till date of sale.
Correct.
Okay.
However, there are some exceptions, things that are out of your control. For example, change in health. Maybe you're in a 2-story house, someone is now in a wheelchair. If you change homes and have lived in that home less than 2 years because of this change in health, you can prorate that exclusion when you move into another house and be able to still qualify for part of that exclusion because of the unforeseen circumstances. Change in job location. If you move more than 50 miles, it can be a short move, but if you're moving because of a job change, and you've lived in the home less than 2 years as your primary residence, there's also a way to take advantage of a prorated portion of that exclusion. Military reassignment, any other unforeseen circumstances that might have come along. For example, witness protection program, if you have to, that was one of the examples. I've not run across that one myself. Anyway.
It's a good one to have in there, though.
Correct. So there are a few specific exclusions to the 2-year requirement to allow people for purposes of unforeseen circumstances.
Okay. So you now own your home, lived there definitely the last 2 of the 5 years. You can plan on how to take advantage of this exception.
Correct.
Exemption, not exception, exemption.
Exemption, correct.
Now, a lot of people, thank you. Yeah, that's what I want to get into,
okay,
calculating.
We'll
so
do that.
You purchase your home for $40,000, $50,000, maybe $100,000, maybe $200,000. Home prices are high right now.
Correct.
And they are projected to go higher. Stomach. Gulp. But they are. And so we are talking about large amounts of money where you purchase your home for $100,000. You might be selling your home for $7, $8, $1 million, $1.2 million right now.
Correct.
And so that $500,000 or $250,000 may not go very far.
May not cover the entire gain. Something that I always advise my clients when they are looking at selling their home is to recap major improvements they've done over the years. Landscaping, swimming pool, fence, finish the basement, major remodels, those kinds of things. Those all add to your original cost basis. So if you bought it many years ago for, let's use $100,000, but you've put in some major improvements, maybe $200,000 in improvements, you're at $300,000 now. That then is your new tax basis for calculating what the gain might be when you sell your home now. And closing costs are part of reducing that gain as well on both ends. Closing when you purchase, a lot of people don't have those records anymore. And then when you sell, your closing costs, realtor fees, etc., will reduce the gain on the sales side. So in our example, if you bought it for $100,000, maybe you put in $200,000 of improvements over the years that would qualify. You're now at $300,000, sell for, let's say, $1 million. So we're at 700,000. That 700 then can be reduced by your closing costs on the sale. That reduces that maybe closer to the 500,000. And then you can exclude the 500,000 if you're married filing joint. For single, it's $250,000 exclusion or head of household.
Yep.
So that gets you closer. So that difference, the part that's over those exclusion amounts, would be then taxed as long-term capital gains on your tax return. Long-term capital gains rates are lower than whatever tax bracket you're in, so you do get that benefit, but the difference between your exclusion, 500,000 in this case, and 7 minus your closing costs, let's
Closer
say
to 150.
yeah, let's say it's 150,000 of gain, that then is taxed at long-term capital gains rates, which will
Right.
max out at 20% federal,
Okay.
and if you're in Utah, it's about 5%. Different states are different rates. Some don't have any gain tax on capital gains, but plan on state tax in addition to the federal taxes.
So 25% of 150,000 is a much lower number than
tax on the full amount.
tax on the full amount.
Correct.
So there's a huge advantage
Absolutely.
to taking advantage of this.
Of establishing that to qualify for the 2 out of the previous 5 years as your primary residence.
And keep track of your records. If you're planning on doing this after the kids move out, keep track of them.
That's right. Keep track of all these major improvements. That'll always help. And if you've got your original purchase documents, there's some closing costs there that help. And then we can hopefully exclude as much as possible.
Okay. Now I do have one stipulation here. We just want to muddy the waters as much as we can.
Sure.
So, client wants to sell their home because the spouse that used to be with them has passed on. They no longer can take care of a property all by themselves.
Okay.
Can they take advantage of still the married filing jointly exemption?
Yes. There's an exclusion allowance up to 2 years after the spouse passes away. So the year that a spouse passes away, you are able to still file married filing joint in that year. The year after, if you have not remarried, you file as single. So according to this law, you would be reduced, you'd have that 500,000 being reduced down to a $250,000 exclusion. However, the tax law allows, in this case, not the way you file your tax return, but in the exclusion calculation, to take advantage of the 500,000 as long as your spouse had lived in the home 2 out of the previous 5 years as their primary residence, as well as you. You can exclude up to $500,000 gain as long as the home sale takes place within 2 years of the spouse passing away.
Okay.
And that applies to quite a few people. I mean, just like you said, you're now in a different stage in life. You don't need the same accommodations, size of home, whatever, so you want to downsize.
And that is a hard and fast rule, that 2-year mark
To the
from
day.
the date of death.
Yeah.
Okay. There are some decisions to be made, and
Yes.
if you delay, which maybe life lets you maybe it takes a delay, and that's okay. But if you have the opportunity to make it happen sooner, then you probably want to consider.
Well, we're
saving
talking
yourself.
about the 2-year period. That does not have to be consecutive. In other words, you could have a period, maybe you go on a mission or you're living in St. George full time, different than where your primary residence was. So you could have a year period here and then be gone for maybe a year, year and a half, 2 years, whatever, and then another year period. Those two become your 2-year period out of that 5-year period. So it doesn't have to be continuous.
Okay.
And vacations or temporary absences because of maybe you're out of town for a month or go on vacation for 2 weeks, those do not take away from your...
We don't have to be that careful in tracking our time.
No, it's really when you make a definite change in where your residence is.
Okay.
But being gone on vacation, you don't have to calculate, taking those days away from...
Now, this is an interesting aspect, the 2 out of the last 5 years. Let's say you lived in a home for 2 years. You now rent that home, and you've been renting it for 3 years. In order to take advantage of that, you must sell before the end of that 3rd year to take advantage
Right,
of that.
it has to be within
year.
that 5-year period. So you can, if you choose to, your primary residence is now converted into a rental property, as you suggest, and you rent it for a little while, I always tell my clients, keep track of when that full 5-year period might expire, in case you're close to, say, wanting to sell that home. You can still take advantage of that. Even though it's been converted to a rental property, the 2 out of the previous 5 years still is your primary residence for that qualifying period, and you can take advantage of the exclusion of the gain for that time period. However, if a property has been used as a rental property or any kind of investment property where you're depreciating that property, meaning every year you take a little bit of depreciation as a deduction, that needs to be recaptured. In other words, when you sell that home in your example, the 2 or 3 years of depreciation would be recaptured when you sell the home as ordinary income, because it has reduced your income in the meantime and you're now selling it, so that's recapture. So if you took $30,000, $40,000 of depreciation in that time period, you'd have that much that is recaptured at ordinary tax rates, not capital gains rates, because of the way it was taken in the first place.
Correct.
But then you still have the exclusion of the $500,000 gain on that primary residence. So you can kind of time things, make sure that you don't go past that 5-year period if you choose to do that. If you continue to use it as a rental property after that, it's now an investment property. Say you go 6, 7, 8 years, you're continuing to rent that property. The 2 years that you lived in it as your primary residence is expired. You don't have that exclusion.
You'd have to move back into that home, establish as your primary.
You could move back in if you choose to.
Take advantage.
Doesn't happen very often, but yes, you could do that.
Not with an extensive remodel.
True. Now, while we're talking about that, there's
Yes.
another option there. We've talked about 1031 exchanges.
Yes, let's get into that.
1031 is a code section in the IRS code, so it's code section 1031. So people talk about 1031 exchanges, meaning it applies to this code section. Also referred to as like-kind exchange, meaning if you're in an investment property, you can exchange into another investment property without paying tax on maybe the gain on this first property, without disrupting anything. You can still reinvest the full funds from one property into the next. 1031 is a whole other subject, but you have to kind of plan that ahead of time. You can't decide after the sale that I want to reinvest this into another property.
Yes, there is a whole nother procedure for 1031.
Whole nother video.
If you're wanting to do a 1031, definitely plan it before. It's really difficult.
If you've received funds on the sale, it's too late.
Yes.
So you need to plan ahead. But in the context of what we're talking about here, you may have an investment property, a rental property, say, that you roll into another property. And when I'm talking to my clients about this, I say, maybe choose a property that is livable for you and your family.
Maybe you want to downsize into.
Maybe. And it's in a location that you like, etc. Kind of think this through ahead of time. So the intent in a 1031 always has to be like kind. So in other words, when you make that decision, you are going to rent the new property as you did the old one. But you're still thinking this is a possibility down the road somewhere. With a 1031 exchange, as long as it's at least a year after the exchange has taken place, you could say, the rental thing isn't working out, let's make this our primary residence. It has to be at least a year after. And if you were to make that your primary residence and at some point down the road want to take advantage of the exclusion by selling that property, that has to be 5 years after the like-kind exchange took place.
Not 2 years. If it's been taken advantage of a 1031,
that changes the time frame.
You have to wait 5 years.
At least 5 years, and it has to be the 2 out of those 5 years that you lived in it. But it is possible. You still have some gains because of the character of the property having been rented. You have the depreciation recapture, and also some prorating of the total time period you own the home. It's all a little more complicated than we can do here, but realize that if you've lived in it 2 years and it was owned a total of 10 years, 2/10 of the gain is available for the exclusion.
Okay.
So it's a little more complicated than we can cover here, but just be aware that if you're working with 1031 exchanges and have some non-primary residence history with that property, you can still exclude portions, but it's not fully available to you because of having used it as a investment property.
Still a huge tax benefit.
Absolutely.
By
Absolutely. You want to take advantage of that.
planning ahead and doing it that way.
Perfect.
But it's not as easy as if you just bought it as a primary residence.
Correct. It's a lot cleaner if it's always been your primary residence and then you sell it. But having an investment history in a property does change the availability of that exclusion.
So getting into this, now a 1030, well, a primary residence or a 1031, a primary residence that I want to pass down to my kids. When should I do that? Should I do that before?
Let's talk about that. Well, I've run across some situations both ways where they transfer it to the kids before they pass away. If the home is received as a gift or transfer in this case, the holding period and the basis of that property come to the kids. So in our example, $100,000 purchase many years ago, yeah, it's long-term hold, which is great, but it's a $100,000 basis. So they would still have that $900,000 gain if they sold it for $1 million. If it's transferred as a gift. If it's transferred as an inheritance, in other words, the parents own the home, pass away, the kids inherit the home, there is something called a stepped-up basis, meaning whatever the fair market value of that home, in our example, let's say $1 million, the step up in basis means that home is now inherited at $1 million. If the children don't want to keep the home and they decide to sell it fairly quickly after the parents pass away, they can sell it for $1 million and not pay any tax on that gain. So it's extremely important to take advantage of that stepped up basis if that works with your other plans. Sometimes transfers of property are done for other reasons, but to be able to inherit that property, you then don't even worry about the $500,000 or the $250,000. That step up in basis wipes out the gain at that point.
Just clears it. You don't have to live in it for 2 years or anything like that.
That's right.
You're just good to
Doesn't
go.
even have to be your primary residence.
And this is a good tip. If you do inherit a property, it is amongst everything that is going on. But before you even decide if you want to liquidate the property or keep it, regardless, it's a good idea to have a property valuation done, appraisal or whatever, just to establish that value.
And that's where you come in.
And that's contact me, and we'll get you taken care of that way, because that'll be a really important step for the accountant in figuring out.
It establishes the basis at that point.
Yeah.
Sometimes when I hear of someone passing away, that's one of my first pieces of advice. Get a market analysis or an appraisal. Doesn't have to be an appraisal, but get something that is concurrent and says, this is what this property is worth.
Is there a time limit?
Not necessarily. I mean, if you're within a week or two or a month, you want to establish it within a close enough time frame that you've got the paperwork that says this is why we're using this as our stepped up basis valuation. Hopefully markets don't change so fast that a month doesn't make a difference. There's a lot of things to think about when someone passes away. You're not necessarily thinking about.
Yeah, that's not
let's
top
talk
of
to
mind.
James.
It's okay if a couple months, and even historical appraisals or historical market evaluations are a thing. We can go back in time and look at data and assess it that way. They tend to be a little pricey, but it is possible if it's been too late.
I've had some clients who just use the property tax evaluation, which isn't very accurate. It's usually a little bit low.
Yeah.
But if it fits with their sales price and the fact that they aren't having to pay any gains after closing costs, still fits. At least you have some paperwork on file. That's the key, is something that documents how you're establishing that stepped up basis value.
Okay, so things we're learning. Plan as much as we can. Life happens to all of us, and we can't plan ahead. But as much as we can, plan ahead. It is really difficult to go backwards and make things happen. Sometimes you may transfer and gift a property to somebody without knowing about the tax basis staying the same and that tax liability that they now assume. There are a whole lot of pitfalls that can occur, but by talking to a tax professional,
Do the best we can.
yes, to at least hopefully plan.
Something else that might come up question-wise is trust. Sometimes
Yes.
parents have maybe established a trust, and I'm not an attorney, but there are two kinds of trust, a grantor's trust and a revocable trust, that basically are invisible until the person passes away. So you still get that stepped-up basis. Like I say, there are tons of kinds of trusts. I've worked
And a
with so many.
trust is in place. If the trust is in place, you don't have to go through probate
Correct.
when someone passes
So that
away.
saves you that problem, and also you, even though the home has been moved into one of these trusts that work this way, you don't want to have an irrevocable trust or other kinds of trusts. There are so many different kinds, but if it's a revocable trust or a grantor's trust, it's as if it isn't in place until the person passes away. So you still get the advantage of taking advantage of the stepped-up basis or the exclusion if that applies.
Okay, excellent. And those are regarding trusts.
It's a whole
Contact. It's a whole nother video. Contact your attorney.
That's right. Don't take my word for it. It's good for you to know what kind of trust you have.
In the world of taxes, those are the great ones. But you may have one great for your situation which you are in. Dean, this has been awesome. So much information. Feel free, scroll back and watch
Replay.
it again. There's so much information here.
There is a lot to cover, and obviously there's probably some special circumstances we can't cover every possible way, but hopefully we've given some good information to those that need it.
And I think that's the key is here's a professional, talk to him. If you have your tax professional, talk to him. But we're going to put the information for Dean, how to contact him, his website and phone number on the screen and in the description below. Dean, thank you.
You're welcome.
This has been amazing.
Well, good. Hopefully it's helpful.
100%. All right, until next time, thank you.